I just want to see this one thing first. And hang on one second, guys. Change my display size. Man, whatever. All right, so we're going to start right about now. So this is long-term gold wave count with Tony Marcucci
and Dan Keegan.
So this is a risk disclosure which says past performance is not necessarily indicative of future results.
Which means when you trade, you lose money. Hopefully you're making a lot more money than you lose, but losing money is part of trading.
Exactly. Yeah, and there's definitely risk involved. So Dan Keegan, he started out in the option business in 1978 and worked his way up in the Chicago tradition. Dan spent 5 years as a runner, phone clerk, and he was also backed by the legendary trader Steve Fawcett. He began a 20-year career as an independent market maker on the floor, and Dan was also traded on the CBOT and treasury bonds and soybean oil futures. And he's also a contributor to Futures magazine.
And Tony Marcucci, Central Michigan, Chippewa. He's got a degree in finance, and when he was in his dorm room, that's when he started his trading career, which I wish that was available to me with the electronic world right now. That it is available basically everywhere with the platforms that are so updated, and the commission structures are terrific now.
No, exactly. So first we're going to do a recap of last week's webinar for those of you that attended. And so first, based on Elliott Wave, we looked at 95 to 98 call spreads in crude that were trading for roughly $1,000 at the time.
So it was 1 point we had to trade at.
Yeah, exactly. One point crude is...
One long the 95, short the 98. And where was the crude at that time, basically?
We were looking at when it was trading like 94.50, somewhere in that range.
So it was an out-of-the-money vertical.
Yeah, exactly. Yeah, initially. And so we want to kind of show you how that's is done so far this week. On here. So somebody's telling me that it's not showing up. Let's see. You know what? I think it's this.
Okay.
That's good.
Yeah.
Okay. Good.
Okay. And by the way, at any point during this webinar, please feel free to type in a question or something you want to look at that we're not looking at.
Yeah. So as we were saying, we were looking at so we were looking at 95 to 98 crude calls based on Elliott wave, and currently the market's trading around 97.40 last I looked. And we thought there would be, a good correction in the crude market. So roughly, right now,
What was the high it got to?
97.84 was the high a couple days ago. I think it was set on Friday.
Mm-hmm.
And we thought there would be a consolidation, and so we'll show you. This is where the market was trading during our last webinar. And we thought there would be a consolidation, as you can see, from my A up and then B consolidation. So based on Elliott wave, we're going to look for a C wave higher now with a 1, 2, 3, 4, 5. And so we'll see if we can complete that. And then the other thing we were looking at.
So what's the vertical trading at right now?
So the 95-98 spread is trading at roughly 2 points or $2,000. So it's
okay. So the Elliott wave saying it went up to that level, buying the 95, selling 98s was pretty much the spot-on strategy.
Yeah, exactly. It went up to 97.84. So that was kind of the level we're looking for. And then now we're looking for a little bit higher highs than our previous high that we set.
And which would work great for that spread because you want
you want
98 or above. So
yeah, exactly.
Closer it gets to expiration, and the more it gets in the money, the closer it gets to its max value of 3.
Yeah.
So you could actually take off, depends on how many times you could take off part of it before the actual expiration takes, lock in some of your profits.
Yeah, exactly. And then the other thing we're looking at in the energy space was the heating oil market. We thought we were in a consolidation phase, and based on Elliott wave, we thought we would finish the pattern. So we were looking at $3 to $3.10 call spreads in heating oil for $12.40. And I'll show you that chart that we saw last week. This is a chart of heating oil last week, and we thought we would complete the pattern and make it up to the E wave based on Elliott wave, which is roughly the 310 to 314 level in March. And we've seen some pretty significant upside over the last 2 days. Let's see, I can pull up a chart of that. And so here first is crude oil. Crude oil on an hourly chart. I'll show you on the daily as well. So here is at 97.84 level, and then we backed up all the way down to about 95.20. And currently it looks like we're starting to make a little bit leg higher. And here's the heating oil chart. So when we talked last week, the market was trading around this 97 or 297 level, and as you can see, we've had a pretty significant increase. Right now, we're trading about 302 in the spread, so it's moved.
So at the 297 level, we entered into the 310 spread.
Yeah, for roughly. Yeah, exactly.
And what was the entry price we paid for that?
Roughly 1,200.
Right, 1240, I think it was.
Yeah, exactly.
Okay.
And so currently, I think that spread is trading for around 5 cents, which isn't a massive increase, but the market has been moving our way a little bit based on Elliott wave, and we're still waiting to see if that can complete the pattern. So
okay, so those are two things that worked out well for us from
Yeah.
last week's recommendations. Not going to happen all the time, of course. That's the nature of trading.
Yeah.
But,
we think we're going to do this every week. They'll go through a little review of what we thought Elliott Wave would do, and show what the actual market is doing. So under Elliott Wave, we still believe, in my opinion, that this wave pattern is going to be completed, and we'll see in the next week or so what happens in the heating oil market. So going forward, we're going to look at the gold market, and these are Elliott Wave consolidations. I'm going to show you in future slides, in my opinion, where I believe the gold market is in Elliott Wave, and in Elliott Wave, this is an ABC pattern, and so this is what I believe we're looking at in the gold market.
So where are we right now? We're right there at the C.
Yeah, exactly, correct. And so this is where I believe, and I'm going to show you why I believe that we're in the C consolidation for gold. All right, so here's a long-term chart of gold, going all the way back to about 1800. And as you can see, I mean, this has been a pretty massive increase in the gold price, especially in the last 20 years, from about 1980 until now. Went from 20 roughly to 2000.
Yeah, and adjusted for inflation, I believe 1981 is the all-time high.
Yeah, because in 1980, price of gold was at roughly 900.
900, but what you could buy with $900 in 1981 is a lot more than what you could buy.
Yeah, especially
in
even
2014.
Well, with the inflation rate too at 15 to 20%, it was drastically higher
for a while. Yeah, really.
And at our 3% now, it's a big difference. So as you can see, I have drawn in our one higher, our two consolidation, our big wave 3 up.
And then we're looking at that one period of time when it's pretty flat right here. Obviously, that's when we're on a fixed rate, right?
Yeah, exactly.
Bretton Woods system.
Yep.
And when Nixon took us off it, then it was just been a wild ride of trading for gold.
Yeah, exactly. Yeah, and the reason I'm considering this a 3-wave is because the monetary gain is much greater during this period, from 1980 or from 1950 until 1980. I think it was roughly 17 times or 20 times the value. And even though we've seen a big increase from 2000 to 2011, it was actually much smaller than this big increase that we saw during the time. And that kind of lines up with the wave 3 higher. So now I'm going to break it down into a little bit shorter time frames to show you where we currently are, but kind of keep this in the back of the head, where we currently are in the gold market relative to Elliott Wave. So this is a chart of gold from 1975 till today. And you can see this big consolidation that we saw from 1980 to 2000. And that's usually lines up with a 4th wave consolidation. It usually is in a triangle, not every time, but that lines up with what Elliott Wave rules state.
So at 2000, it just took off for the races.
Yeah,
right
exactly.
There. And it's retraced, what, about a third of it?
Yeah, I would say, looking, roughly a third of it.
Right.
And you can also see this big decline that we had in 08, with the market crash, and then eventually a even bigger run, higher.
Mm-hmm.
And so where I believe this is under Elliott Wave, in my opinion, this is our 5th wave higher in the gold market. And I believe currently this price action we've seen from 2011 till today is an ABC consolidation, and would be our 4th wave lower.
So you're saying right now there's a bit of consolidation.
Yeah, exactly. And you can
now, is that reflected in the option prices?
I think,
in other words, the implied volatility, which is the amount of time value that's embedded in the option premium, when that's at a low level, that's saying that the implied volatility is lower. In other words, nobody really believes there's going to be a sharp move up or down. It's reflected in the options prices.
Yeah, exactly.
So what will be basically the implied vol?
I think we're looking at, roughly 2 days ago at least, before this Fed announcement. Usually they'll pump some volatility with the Fed announcement coming out today. But we're trading around 15.5% implied volatility.
Mm-hmm. When that's at the low end, at the high end, it'd around double that. Or?
Yeah, I would say roughly 30. I'm sure even that gold market's moved over $100 in one day before, and I'm sure you could see as high as 40% implied volatility in a day like that.
And then we also look at the skew for gold, and that's looking at the out-of-the-money calls and the out-of-money call puts. If they're equidistant from where the futures contract is trading,
yeah.
If one is starkly higher in price than the other one, then that's indicating that the move in that direction will be much quicker.
Yeah.
Not necessarily that it will move, but if it does, it'll move much quicker. But it seems like the out-of-the-money call and out-of-the-money put, the equidistant ones, are roughly equal in price.
I think a little bit slanted towards the put side, but basically equal.
Mm-hmm. So they think if it does go down, it'll happen a little more quickly to the downside than to the upside.
Yeah.
The movement will be.
So based on Elliott wave, we're looking for the market to complete a fourth wave consolidation and possibly retrace 100% of this move. So we're going to go a little bit further. So basically what we're trying to identify is corrective waves and impulsive waves. And the difference for me for a corrective wave is there's a lot more overlap and a lot more indecisiveness of the market. There isn't a true direction. It's a lot of choppiness and back and forth, but it's not really a true trending market higher or trending market lower.
Okay. So,
and that's where I'm making my distinction in Elliott wave that we could be in a corrective phase, in my opinion.
So the congestion is looking to be at its end, and there's going to be a move.
Yes.
Now, obviously, any time congestion's over and can make a move, it can go in either direction.
Exactly.
Now, if the Elliott wave reading is not correct, how much further down would Elliott wave say it could go?
So if my current count in Elliott wave is wrong, then that means the gold market is already starting to see its declines and is already seeing the high price that could potentially be that we'll ever see, and that the decline is just starting to begin, and that we could see drastically lower prices. Under the fifth wave rule of Elliott wave, we would see a lot drastically lower prices.
So, and other than that drastic area, if it just completes, if it was to go down just in a mild manner, how low would you think it would? Would Elliott wave think it could go?
Yeah, I mean, so if we, there's some percentages, and let's go to the next slide, and I'll show you some of the percentages.
Okay.
So as you can see, and I drew in my ABC consolidation, and this is where I thought we've reached our third wave higher, which is, part of the hype of the market was breached back in here. I remember, in 2011, people thought gold was going to go to $5,000 an ounce, and that, lower price would never be seen. And that's kind of what Elliott wave does, is it tries to use the psychology of the market.
Analyzes the emotions of the trader.
Exactly, to determine, the peak of the market and also the bottoms.
When there's the froth and when the laggardness is over with.
When people are when you're, bankers telling you to go buy gold instead of stocks, or, a scenario like that.
When your cab driver's getting rich, go long gold, then you know it's time to.
Yeah, exactly. And so this was our recent high, and I believe this was an A consolidation lower. And using Elliott wave rules, it states that our C wave cannot go 162% more than our A wave. And so I did some math for us. The height of the A wave was 1923.7. The low was 1520, call it. And so if you divide or subtract those and then times it by 162, and then you minus that from our B wave, that price would be roughly 1150. And this is kind of just a general a point for me. It's not necessarily a line in the sand, but under Elliott wave rules, it says that if wave C exceeds 162% of wave A, the labeling is probably wrong, and the current pattern is probably impulsive, meaning the current wave pattern would probably be meaning that it's a downtrend and not reverting back to the uptrend of the market.
Okay. So that's why maybe just being flat out long the futures contract wouldn't necessarily be the best.
No, exactly. And given gold's large leverage, so for $100 in gold in a future contract, that's roughly $10,000 a contract, which is a lot of risk for any trader. And
yeah, because on the way down, even though you have a ton of leverage at the beginning, and if it moves up, it's a terrific return. But if it moves down, you got to be constantly throwing money at it.
Exactly, and it becomes a little bit strenuous on you too. So that's why that's why we would look at some option type strategies based off of Elliott wave to try and put some skin in the game and see if this wave pattern is correct.
You want to benefit if that's what you believe is going to happen. You want to benefit, but since you're not always right, you want to make sure you're not wiped out either.
Exactly. And so the main thing that I want to focus on with the gold market going forward is trying to find a definitive wave one higher from this point. Now, it doesn't mean that's going to happen, but based on Elliott wave, if this is correct, we could look for a wave one higher. And if this pattern is correct, we would retrace 100% or more of this ABC consolidation, meaning we would make a new high in the gold market based on Elliott wave's theory. So this is currently where we're at. I think the real line in the sand for me is going to be this 1850 level. If we break that, I think that's some major downside of the market, and so that'd be a level I'd be.
So now, what to the upside, where assuming that this is congestion and it's making that move up again?
Yeah.
What would be the initial move up? According to Elliott wave, it
doesn't give you a definitive. The price is going to here, and that's one thing. You kind of play it as it goes. In like a daily chart, you might look for little intermediate wave counts.
Okay, so you could make adjustments to your options position.
Yeah, exactly.
Based upon that, amongst other things.
Yeah.
Obviously.
And so the one thing I also want to talk about too is that sometimes under Elliott wave, the market will truncate, meaning the market was unable to make a new low. If you count down from this B wave, you should be able to make 5.
So it kind of truncated the move.
Yeah.
In other words.
So normally you would get a 5 wave down, and this would be considered a 4th wave, and this should have been a 5th wave lower, but the market was unable to make a new low at that point. And that's under Elliott wave, that's called truncating, meaning the bears were unable to sustain control of the market. And I can show you that on the previous slide. So this is called a truncation. As you can see, we made a 3rd wave lower in this ABC consolidation right here, and then we had a 4th wave higher, and the market was unable to make a lower low than the previous 3rd wave. Now, it's not for certain that this is a truncation, but it's starting to look like that in the market, and that is something allowed under Elliott wave rules. And it says you can have a truncated 5th wave that does not move beyond the 3rd wave under Elliott wave rules. So now we're going to look at using Dan Keegan's option expertise. We're going to look at some of the opportunities in the option market, and I'll let him talk about some of this.
Okay. Okay, first off, we're looking far out in the May expiration, which is almost 3 months where there's expires. So we're going to establish a spread, and what we're going to do initially, we're going to go along the 1350, 1400 call spread. So that's quite a ways out of the money at the time.
Yeah, and that's kind of a risky proposition. To be honest, most far out of the money, far time value options usually expire worthless. So it's kind of a risky option strategy. And,
we're reducing the risk though by not just outright buying the 1350s. We're selling the 1400s to cut down on our initial outlay for this strategy.
Exactly.
Reducing our risk by the amount by selling the 1400s against it. So this would be a total of $500, right, for each one time we establish this.
Yeah, exactly, which is 5 points in the futures market.
Mm-hmm.
And so this is, like it says, there's 86 days left to expiration. So it's saying, 86 days from now, if gold is trading over 1355, you potentially could make some money on this spread.
And if it was even trading at 1340 with like
Days
76
left.
days from now, you'd still have some value in the spread, so it wouldn't have lost everything. Now, if it's right here, 76 days from now,
then we're probably going to...
You probably would have lost all but $50 of this by that point.
Yeah.
Doesn't mean it couldn't make a comeback and run up above there. But by then, so that's how these spreads work. The closer you get to expiration, as they're in the money, they tend to expand quickly. But if you're out of the money, they tend to, both the call that you're long and the call that you're short will go near to worthless.
No, exactly. And this is all just based off the Elliott wave that we previously talked about. And, so if that wave count is correct, we would look for some higher prices from this point.
So there's another layer we're going to add to this, okay? Since the cost for each time we do this, and it is quite a bit out of the money, it's $500, and we believe that this next wave is going to be the upside, then we're going to help finance this out of the money call spread by selling an at the money put spread.
Yeah.
That expires in only a little over 3 weeks.
Yeah. So it's shorter dated. So it's, we don't have to go out as far with uncertainty at least.
Right. So this spread, we're able to collect $500 for each time we do it. It's a 10-point spread, so we're getting about half the value of it. It's an at-the-money spread, so that's about par for the course.
Yeah, and it's a covered spread too. So the most you can lose on it would be the additional $500 that it would maximize at expiration.
Right. The maximum value of this 1250, 1240 spread is $1,000. It achieves that at 1240 or lower.
Yeah.
Okay. So if it stays where it's at or keeps moving higher, this spread will go out worthless, and we get to collect the $500.
And then we still would have on our $1,350, $1,400 longer term call spread at a relatively free price minus commissions and fees.
Should the initial spread we establish go out worthless, then it would be a free spread. Of course, the commissions would be part of it as well.
But so the most you could lose using both of these strategies, at least from my understanding, would be $1,000. The $1,000 you would lose on the $1,350, $1,400 call expiring worthless.
Yeah, we'd lose $500 on that but let's take it first one at a time though. Let's say the vertical put spread goes in the money, goes all the way down to 1240 or lower. Obviously the call spread is going to drop in value, but it still has a lot of time left, so it'll still have some value left. But we'd lose the $500 on the put spread. So at that point you could either blow out of your call spread, and it might be a couple $100 left in it, maybe $150 left in it. So, or even if you have that's the thing, most of these textbooks on options will show you what things look like at expiration. But in reality,
it's much different.
Most option traders, they don't establish a position, then go into a coma and wake up on expiration day. They're making adjustments along the way.
And that's the whole key to trading options, is making the adjustments.
Right, right. Mm-hmm. So if it starts heading in that opposite direction, there's things you could do to it. You could maybe get out of part of your call spread or sell some other call spread to help cushion the blow of what the spread you're long on the way down. Of course, it could reverse course. There's no pure way of making money in options, but the great thing about options, you have a million different exit doors and a million different entrance doors.
Yeah.
That gives you more, can I say it, options?
Yeah. So what's the other worst case scenario in this type of option strategy?
Well, just if it does go below 1240 and keeps heading down there, obviously your call spread's going to go to next to nothing, and still have some left because it's still going to have another 60 days, another couple months left. But your put spread would go totally in the money, and you'd lose on all of it.
Okay.
So
the max you could lose using both strategies would be $1,000, and then just the 1350 to 14 would be roughly $500. So that's the reason options are good is because you have a defined risk.
Right, right. I mean, if you were to just naked sell the put, the risk wouldn't be defined. It'd be like buying unlimited. A naked long futures contract.
Exactly. Yeah.
So, but when you have that 1240 put that you're buying, you've capped out your losses.
Yeah.
You had to obviously have to pay a premium for that,
Mm-hmm.
and that cuts down your maximum possible profit.
Yep.
But if you want to be trading for more than just a few months, you always want to look to manage your risk.
Yeah.
And that'll you don't want to put everything on a line at one time, because if you're not right, you don't get to trade again.
Yeah.
You want to be able to trade for a long time.
No, exactly. That's the key. Letting your wins run out and trying to cut your losses short.
Right.
I think that's the whole key to trading.
And no matter what you're doing, whether it's just futures or options.
Yeah.
Options just gives you a lot more
opportunities or options.
Right. Once again, no
Yeah.
pun intended.
Yeah, exactly. So the bigger key or bigger picture, we're going to look at the dollar over the next, maybe possibly in the next webinar. I think that's going to be the key to the gold trade. And the dollar has been a long-term consolidation. I see a really good pattern that I like to trade a lot in there. And so that's something that you should look forward to seeing.
They generally have a negative correlation, right?
Yeah.
Gold and the dollar.
Yeah, and commodities in general, too. If the dollar goes lower, generally the commodity space goes higher.
Mm-hmm.
And so if you guys have any questions, or if you're currently looking at the gold market and you have any questions, feel free to send them over now.
Right. Yeah. We'd love to hear any of your questions right now.
Or if you have any market too, or just want to talk about trading in general. I don't know. That's what I'm trying to find. Or was that that other thing? Decrease. That's not that. Going on the other screen. Well, if there's not any questions, hopefully we'll see you guys
next week.
Oh, wait. Hang on, wait. We got a question. Let's see. Joe Meyer. So you can't give a... I wouldn't...
Specific price.
Yeah, I couldn't give a specific price. What I would try to do is trying to identify a specific wave. And ultimately what I want to do is I want to look for a wave 1 up and look for the wave 2 consolidation lower. And I think that offers usually the best opportunity to potentially get long in the gold market. So, I like looking at shorter term time frames. If you can look at an hourly chart and you can start to identify a wave 1 or even a wave 3, I find it easier to identify impulsive waves than corrective waves sometimes. But that's where I would initially look. And I mean, even today with the Fed meeting, it could be as soon as tomorrow. You never know with markets, and that's the thing. Things are always constantly changing. It's not a perfect science. Just trying to improve our odds as best as we can.
Right. That's the key to trading. If it was just a canned thing that you could do, everybody be really rich and everybody make the exact same amount of money.
Yeah.
So,
zero-sum game.
Right.
So I mean, I would look to identify the initial move higher. Just specifically speaking right now, I would trade options instead of pure futures because I can't define my risk. I couldn't say I'm going to buy futures against this level. And when I'm trading futures, I always want to have a stop point where I can say I'm no longer right on this and it's time to walk away. And currently I can't find any level that I would say, this would be a level that I would say I'm wrong. And, I think the level I would look at would be 1150, but that would be $15,000 risk.
And the other problem with using a stop order versus using options is...
Could be right still.
You could touch off the stop, it hits there and moves back up, and you're out of the trade. That's number one. The other one is if you're locked limit down for 3 days and you're carrying the position over a number of days, you can't get out at that time.
So using the options, it would establish a little bit of skin in the game. It would keep the gold market would keep my attention. and it would make me pay attention to it, so that if that opportunity did present itself, maybe I would be able to use futures in the future. Pun intended.
Okay, Shay says, I had to step away. Is there a way to catch up on what I missed?
We're going to be putting up the recording on the website.
I think about a week from now, yeah.
Yeah.
Will be.
You have to, yeah.
So you'll be able to catch up on what you missed.
Yeah.
Yes, that's true.
And then also, kind of look for next week. I'm pretty sure we're going to do it on the dollar, and look for some other opportunities in the commodity markets.
So does anybody have any final questions before we're ready to go? Okay, well, I hope you got something out of it, and I hope you'll be here next week.
Have a good week.
Yep. Bye.